Very much welcome to GAC Presents How to Invest in Stock Market Part 1. Hello friends, very much welcome to this episode of How to Invest in Stock Market from GAC. Up till now we saw what share market is, what a company is, how it evolves and how its equity reaches to the stock market for trading. Thereafter we saw the market structure. There we learnt about various market players. We learnt about market regulator SEBI, then we saw exchanges like NSE and BSE. Further, we learnt about the indices created by these exchanges, Sensex and Nifty. We also learnt about sectoral indices. Further, we learnt about two approaches of equity analysis, that is top-down approach and the bottom-up approach. Further, we learnt about DuPont analysis, where we broke return on equity into three components, that is net income margin, asset turnover ratio and leverage. But to understand this even better, one need to be very much familiar with financial statements. Thus, in this episode, we are going to learn about financial statements, balance sheet, profit and loss account, and cash flow statements and their components. Friends, rather than directly explaining to you what these financial statements are, I would like to elucidate this through an example. And I'm going to take example of the same very fictitious company, GAC, which we discussed in the very first episode. I was the promoter of that company at that time. I had 8,000 rupees in my hand, and with that I was supposed to buy property, plant and equipment of 10,000 rupees and raw material of 5,000 rupees. I didn't have that kind of money at that time in my hand. That's why I approached a bank for a loan of 7,000 rupees, creating a liability of the company for 7,000 rupees. So the company was incorporated with an equity investment of 8,000 rupees and a debt investment of 7,000 rupees. With that, I, promoter of the company, on behalf of company, bought property, plant and equipment of 10,000 rupees. Then I bought raw material, which is called inventory in technical terms, for 5,000 rupees against a cash payment of 3,000 rupees and 2,000 rupees credit to suppliers, thus creating a liability of 2,000 rupees in terms of payables. And thereafter the company remained with 2,000 rupees cash, which is here in assets of the company. So this was the financial position of the company at the very day of its incorporation, that was 1st of January 2016. So friends, right now on the board you see one of the simplest example of a balance sheet. A balance sheet is a statement of financial position of company at any given day. In this case, on the day of very incorporation of the company, that also happens to be 1st of January 2016, this is the financial position of the company. Usually in balance sheet you will find equity section, that's a liability which company owes to its shareholders, equity shareholders. Usually you will find more subsections in regular balance sheets of the companies. In our case, it's just simple equity of 8,000 rupees because the company hasn't operated much as of now. In this case, this has been the very first day of the incorporation of the company. That's why we will introduce you to further subsections of equity later in our videos. Thereafter, you will find a liabilities section. There are two kinds of liabilities: non-current liabilities and current liabilities. Non-current liabilities are the liabilities created for more than a year. Like debt. Debt is usually taken for 2 years, 3 years, 5 years or 10 years. That's why debt is considered to be a non-current liability. Thereafter, we come to current liability. Liabilities which are created for less than a year, like payables. Payables is what we owe to our suppliers, those who are supposed to be paid within a year. That's why payables is considered to be a current liability. We'll discuss about more these sections, current liability and non-current liabiliity, later in our videos. Thereafter, in balance sheet, you are going to find asset section. Again, you will find the same very subsections in this section: non-current assets and current assets. Non-current assets are the assets by which company is going to get benefited for more than a year, like property, plant and equipment. Usually property, plant and equipment is there for more than a year. Company is supposed to get benefit of them for 5 years, 10 years, 20 years, like that. That's why it is categorized as non-current asset. Then we come to current asset. Current assets are the assets with which company is going to get benefited within 1 year period of time, like raw materials or inventory. This is supposed to be converted within finished goods within a year of company's operation. That's why it is categorized as current assets. Cash is also an example of current asset in the same very manner. So these are various components as of now of the balance sheet. Now we will learn about the profit and loss statement again through an example. This is the very first day of incorporation of the company. Now here onwards, company is going to start operating in the market. We will see the journey of company that way. So friends, in today's session, we learned about balance sheet and its components. Friends, we tried to understand these components through example of a fictitious company, GAC. That's why we couldn't have discussed an exhaustive list of components of balance sheet. This we would be doing in later episodes and sessions. Friends, now in our coming session, we are going to learn about profit and loss account and its components. So stay tuned with us to learn about profit and loss account and its components. Friends, concluding today's session, I have to request to you that if you like our sessions, do subscribe to our channel, like and share its videos. This motivates us to keep creating such videos. Once again, thank you very much.